Hopefully you are seeing my slides. And as you all probably know, I'm Robert Larson. I'm a dental law attorney. But today we're going to be talking about asset agreements, both buying and selling. It's kind of basically the same thing. But to start off with a little interesting tidbit about myself, I am a huge Doctor Who fan. Everything Doctor Who, old doctors, the new doctor coming up, they're all great. And that character right there is River Song. She was the husband or the wife of the doctor. And so sometimes you'll hear me say, hello, sweetie, or spoilers, and that's primarily because of her. She was just a rocking character. So just as a disclaimer, this information contained in the presentation is only for general purposes. It's not intended and is not considered to be solicitation for new clients or engagement with a prior client. Additionally, the information and material contained here are not intended to provide anybody with legal advice and does not constitute legal advice on any subject matter which you may feel. The information provided in this presentation is not a substitute for obtaining and consulting directly with a competent licensed attorney in your state of your own choosing. Always important to have a good attorney. So today we're talking, there we go, about the sale of assets, sale and purchase of assets. Oops, I actually skipped a slide. So the essential parts of an asset purchase agreement are listed here. These are, I would say, the big 11, but some are a little bit more important than others. What assets are included? What assets are not included? Accounts receivable. I put remakes and prepays, but that's primarily for dentists. Assumption of liabilities, the purchase price and allocation, hugely important. Representations of warranty and seller and buyer, indemnifications, conditions closing, post-closing transition services, which most sellers are going to provide, restricted covenant, another hugely important part. And then miscellaneous. It's going to be kind of the kitchen sink where everything else is thrown. In an asset purchase agreement, these are going to be there in some form or another, but the order might be very different. So the sale of assets. What are you buying? Typically, you buy the assets of the business. You don't buy the shares of a corporation or the membership interest of an LLC, because doing that, you actually obtain all of the obligations that exist prior to your closing. So typically the assets are only going to include hard assets, think computers, machines, those types of things that you actually lay your hands on, and intangible assets. That's going to be hard, goodwill, websites, things that exist in the world, but you can't actually go and touch. And typically there'll also be a schedule of what those assets are. The sale of assets will be specifically listed in the asset purchase agreement. Those things that are included, big items. What's also going to be included in the asset purchase agreement are the things that are not included. These are going to include cash on hand, financial accounts, any money or money substitutes, accounts receivable of seller. So that's money that the seller is owed for work the seller has already completed. Prepaid expenses, prepaid taxes, and then personal items. Nobody's gonna buy your knickknacks, and no one wants to buy my Doctor Who crap. They just don't, which I find heartbreaking. So, assumption of liabilities. So sellers' ongoing liabilities. A lot of times there'll be contracts that the buyer is going to want to assume following closing. These could be service contracts, IT contracts, things like that. But the buyer has the option to either assume them and continue them on or not. In dentistry, it's always the practice management system, Dentrix. The buyer has to have it because that's where all the records are actually located. Next, purchase price and allocation. This is probably one of the two most important parts of an asset purchase agreement. The purchase price. It is important to know how much you're being paid. Hard stop. That has to be very clearly, specifically written out. And then the allocation. So the allocation is negotiated between the parties and their accountants. If your attorney is a tax law attorney also, he or she can negotiate that also. But someone like me, I can tell you generally where it's going to end up because I've done this for a long time for dentists, but I can't say it has to be this. So allocation is broken down into two primary subjects, goodwill and hard assets. It can be broken down further. Hard assets can be, supplies and inventory, and then furniture, fixtures, and equipment. So mind you, these are all things that are actually, exist in the world you can touch, whereas goodwill you can't. It's like Kathy runs a CBD store. People may very well go there because they like Kathy. They feel she's very informative, that she's got a great personality. Those are things that are intangible that you actually can't put your hands on, but that are very, very valuable. One of the important things in New York is that for a regular business that has to collect sales tax, you have to get a pre-clearance from the Department of Finance. It's called an AU 19610. Actually, I just want to touch one thing more. So the reason why the allocation is important is because goodwill and hard assets are taxed at different rates. Hard assets are taxed as regular income. So if you've had a good year and you get more added to your income that year, that can increase your taxes a lot. But goodwill being taxed at capital gains, which is a noticeably lower and more favorable tax to the seller, is generally a better thing. So remember that goodwill is essential to the transaction, and you want, as a seller, for it to be as high as possible, because you're going to get a much better tax treatment on that money. Representations and warranties of buyer. To make it, the down and dirty on these, the seller basically says, this is the status of the practice. There's no lawsuits against me. There's no claims by the state against me for sales tax or anything else. The business is being run in the normal course of business. There's nothing material that you need to know about. A rep and warranty in real estate, think about, they'll tell you that there's no environmental hazards located on the property. Well, this is kind of doing the same thing. Seller has legal title to sell the property or the assets. Buyer's warranties are very similar, but typically they're a lot shorter. And whereas I could go through all of this, it's not necessary. It's important to know about them and to know that they're there and what they are, as both the seller and the buyer, depending on whose shoes you're standing in. Indemnification is a very important part of any sales transaction. So indemnification is a very fancy term, a legal term that says, I'll protect you from my prior bad behavior up to the day of closing, and you have to protect me from your bad behavior from the day of closing on. So, but indemnification, the legal definition, is the act of compensation for loss or damage sustained. Once again, like I said, the seller is responsible for everything up to the day of closing, and then the buyer is responsible for everything after the day of closing. Closing conditions. So most of the time there are going to be closing conditions. Some of them are very simple, that there's no breaches of the warranties and representations on either part, and then the delivery of all the appropriate closing documents. For a buyer, the two most important closing conditions are financing. You can't buy something if you don't have the money, and typically an ongoing lease. So you don't want to buy something and then have no place to actually do the work. If you're a photographer like Gene, you're going to want to have a studio. If you're Kathy, you need to have a place to sell the CBD products. So those are important to have and make sure that they're done appropriately.
Hey, Robert, you got 2 minutes.
Very good. Post-closing transition services are very important. Most sellers are going to be providing something following closing, depending on whether you're going to be a W-2 employee or a 1099 independent contractor. That all depends on how things are negotiated. Restrictive covenant, very, very important. In the state of New York, the restrictive covenants have to be reasonable in scope and duration. So scope is the geographic area, duration is the amount of time, and those can vary. But it's really important that if you're the buyer, you don't overdraft, because in the event of legal action, your restrictive covenant won't be revised by the court. It'll be all thrown out. We could go into this in more detail, but just be very aware that it's really, really important. The area of a restrictive covenant is directly related to population density. The higher the population density, the smaller the restricted area. The lower the population density, the much bigger the restricted area. And then the agreement will have miscellaneous provisions, like notice provision, record retention, discussions with employees, governing laws, how they're going to be, the agreements are going to be executed, different things like that, and any kind of related transactions. If you're buying and you're also going to buy the real estate, they have to cross default. If there's a default in one, it's a default in the other automatically. And then there'll be a list of schedules, which is really good. So I'm going to round this out. It was a very, very quick down and dirty about asset purchase agreements. And another interesting fact about me, if you didn't know, I am a hardcore royal follower. Here are some pictures of the Queen. The one on the right with the green velvet cape, that's actually the official portrait of the monarch of Scotland. Was taken at Stirling Castle. And the Queen peeking around on the bottom left-hand corner is actually peeking at me in my Halloween costume from last year. That ends it. So I'm going to stop sharing. And if anybody has any, so I promised, so first person to raise